SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this SUERF Baffi Bocconi webinar on the 2023 banking turmoil, déjà vu all over again. The March 2023 banking turmoil was the most significant stress in the European and US banking systems since the great financial crisis in 2008. It started with the forced takeovers of Silicon Valley Bank, First Republic, and Signature in the US, which were organized after an unprecedented digital run. The turmoil culminated in the sale of Credit Suisse, a global systemically important bank, to UBS. The bank failures, while having largely distinct causes, triggered a wave of question marks about the resilience of banks, banking systems, and the financial markets across multiple countries. In response, large-scale public support measures were deployed by several countries to mitigate the impact of the stress. In a medium-term perspective, more than 30% of banks, including some of the world's largest, would be vulnerable if the global economy entered a period of stagflation, according to the IMF's October 2023 Global Financial Stability Review. These events and the unresolved vulnerability going forward raise a number of major policy issues which will be discussed by internationally renowned academic researchers, by policymakers and financial practitioners at our event today. Our discussion will be introduced by Martin Scheicher, advisor in the Director General Macroprudential Supervision of the ECB, and Martin is also a SUERF Fellow. Let me express my sincere appreciation to Martin for initiating this event and for putting together such a formidable group of expert speakers. Thank you, Martin. Let me also give a warm welcome to Cornelia Holthausen, Director General, Macroprudential Policy and Financial Stability at the ECB, who will moderate the panel after Martin's introductory presentation. Without further ado, over to you, Martin.
Thank you, Ernest, and good afternoon also from my side. So, as a sort of starting point for this panel, in the next few minutes, I'm going to talk a little bit about what has happened, focusing here on the two main stress events on the US side, Silicon Valley Bank, and in Europe, Credit Suisse. So really giving a bit of detail on how basically these two banks failed, and then talking about also the current situation. And another aim of my short presentation is also to come up with some tricky questions for Cornelia and her distinguished panel then to discuss and to perhaps hopefully answer. So let me talk a bit about SVB, Silicon Valley Bank. This was basically a bank run with a few twists. So there were four key ingredients in the collapse of SVB. First of all, for the first time, we really saw the importance of the concept of uninsured leverage. So this is basically taking the uninsured deposits, so deposits outside the FDIC cover, and comparing the bond portfolios linked to, on the asset side, these deposits. These bond portfolios, in the case of SVB, quite a lot of them were without significant hedging. So for instance, there was not really, although they had done this before, but then stopped a lot of swap activity. And many of these bonds were under the hold to maturity approach. So here the general idea is I keep the bonds on my balance sheet until the maturity. But the problem is if losses arise, and this is the second major ingredient, interest rate due to the repricing of the term structure, then of course the deposits face the risk of shortfalls coming from the asset side. And so this combination of high uninsured leverage, interest rate repricing, weak hedging, and the hold to maturity approach used by SVB specifically were all major factors in their collapse and then was takeover. So SVB actually was not really a big bank. It was number 16 in the US banking system, but sizable in particular, as the name Silicon Valley already implies, in the technology industry. It had managed to escape stricter rules. So I mentioned the hold to maturity as one ingredient. And unfortunately, there was not really enough mark-to-market valuation of their bond portfolio. And this issue of mark-to-market is one recurring theme in our discussions today. So in order to stop the contagion, what US authorities did was they guaranteed the deposits. And then in addition, the Federal Reserve also started a new facility among the many facilities which they already had in the aftermath of the pandemic. This facility offered to swap bonds for central bank money at actually really favorable prices. So valuation not on the market value, but rather at par, which is exactly linked to this hold to maturity concept. Overall, there are still quite some sizable unrecognized losses in the US banking sector, both on the sides of bonds, but also in the context of CRE, a recurring driver of bank losses. So for the panel today, what I would see as questions coming out from the Silicon Valley Bank collapse are in particular related to the pros and many cons of the hold to maturity concept, the issue of stress testing. So how can the supervisor and also the bank really use stress testing to avoid that a sharp interest rate repricing then leads to these large losses and a consequent lack of capital. And related to the interest rate repricing, of course, monetary policy, the impact of monetary policy, and finally also the role of supervision are topics for discussion. Let's now turn to the second major bank stress case. This was Credit Suisse. Credit Suisse is not primarily a story about interest rate risk. It's more a story about many other risks which they faced with their business model, which had severe deficiencies. The risk management of Credit Suisse was already in deep trouble since after the global financial crisis, because actually in the global financial crisis, they did better than UBS. Here, as a really strong illustration, the case of Archegos is quite useful because this was a family office collapsing. Many other GSIBs were sort of already having concerns about this and minimize their losses, but unfortunately Credit Suisse still managed to lose quite a lot of money. All of this then escalated in the first quarter of 2023, so a bit less than 1 year ago. Another loss of 7 billion was announced. This loss then affected, of course, directly the market capitalization and also the CDS spread jumping up, and both of these signals then led to what one can see as a sort of digital social media fed bank run. These further losses in particular also implied equity is eaten up, and further increases in terms of capital in this situation are very, very difficult for this bank. And actually one of the major shareholders had already pointed out that they would not really join any further capital increases. So against this background, depositors and high net worth individuals started to run. 35 billion of liquidity was lost in a very short period of time. But, and this is also sort of food for thought today, at least according to press reports, before the run, Credit Suisse managed to meet the actually rather strict Swiss capital and liquidity requirements. Nevertheless, it failed, and it failed very quickly, as a forced takeover by UBS was the only way out. And in this context, there were then also some specific questions about the role and usefulness of AT1, because this was wiped out, but equity actually got at least a little bit of money. So overall, this bank then collapsed after a history of 167 years within 72 hours. So the lessons, the questions for today are, what are lessons about market discipline? I mentioned specifically the spiral of stock market and CDS, the risk of digital bank runs, the interactions and feedback between liquidity and solvency. Here, of course, a substantial issue of deficiencies in bank risk management and supervision. Finally, let's talk a little bit about the situation at major EU banks. So this is also important because the EU financial system continues to be bank-centric. So not only that banks are anyway systemic, but in the EU system, they play an even larger role than in the US. Overall, we can say that there is a solid position of EU banks with strong increases in capital and liquidity since the global financial crisis, CET1 ratio at 16%, and liquidity ratios are also quite stable, and what is also important, well above regulatory requirements. On our side, one of the contributions to this was also a targeted review of interest rate risk management, which is now going to the typical supervisory follow-up via Pillar 2. One additional important point in terms of resilience of the EU banking system is the design of the monetary policy setup. So there is this concept of the pawnbroker for all seasons, and I would think that actually what the Euro system has on offer is quite a big step in that direction, because we offer a broad range of access to all monetary financial institutions, and also against a really broad range of collateral, including securitizations. Two specific concerns are, first of all, the upcoming loan losses, and the other one I'm going to show in the next slide, and this is equity valuation. So out of this, the questions for today would be about the general resilience of the EU banking system, but also the potential need. Is there a need to fine-tune EU banking regulation, Basel III and so on? So as a last stylized fact, there is the general observation that the equity market is rather skeptical, continues to be, despite some recent positive developments, continues to be relatively more skeptical about EU, in particular Euro area banks, than US banks. We highlight this here in two charts. On the left-hand side, the long-run view since the global financial crisis, and on the right-hand side, using a very useful, helpful tool of bank risk sentiment indicator, we also see how SSM banks were affected throughout the crisis last year. So closing and going to hand over to Cornelia, I would see four key themes for today's panel. First of all, this issues of macro drivers and impact of monetary policy on the banking system, mechanisms of bank riskiness, in particular solvency, liquidity interdependence, and the question of, is there any use of a hold to maturity accounting concept, stress testing and risk management as two key ingredients of mitigating bank risk. And finally, of course, also a number of policy concerns related to market discipline and perhaps excessive pressure from markets, the interaction between this market discipline and social media, which can then really lead to very quick bank runs. And the two last questions is, what can we do to improve the impact of supervision? And on the regulation side, is there any need to sharpen the Basel III framework? And then with this, I would close and hand over to Cornelia for starting the panel.
Yeah, thanks very much, Ernest and Martin, and thanks very much for having me moderate this interesting panel. So I think we have really many questions at hand, and we have an excellent group of panelists. I'm really thankful for Martin to organize this. So let me start by introducing the panelists by the order of which they will give their short presentation. So I would start with Viral. Welcome. So Viral Acharya is Professor of Economics at the Stern School of Business, has held many other academic positions previously, but also has been Deputy Governor of the Reserve Bank of India and was economic advisor to the different bodies of the Federal Reserve Bank, and his main research focus is systemic risk in the financial sector. Then afterwards, I would hand over to Till Schuermann. Till Schuermann is partner at Oliver Wyman. He's co-head of the Americas Finance, Risk and Public Policy Practice. He has advised many central banks, and notably on stress testing, if I understand well. But he also has experience in the central bank, namely at the New York Fed, where he was in various positions up to senior vice president. Then I hope that Francois-Louis Michaud will still join us. Apparently he has connection problems, so but he has another half hour or so to join us. Francois-Louis is Executive Director of the European Banking Authority since 2020. Also, he has a long experience in banking, central banking supervision, both at the Banque de France and also at the ECB, where he was Deputy Director General in Supervision. And yeah, and I think the last but definitely not least speaker is Stefan Ingves, the former governor of the Riksbank and former chair of the Basel Committee of Banking Supervision in a very crucial time. He also served as the vice chairman of the BIS. And I think, so Stefan probably knows everything about banking crisis and regulatory responses that there is. But I think that the wisdom of this panel will probably lead us easily through the next hour and a half. So with that, yeah, let me give simply the floor to the first speaker, and that is Viral, please.
Thank you, Cornelia and Ernest, for this very kind invitation. Thank you, Martin, for the introductory remarks, and I look forward also hearing remarks from Till and Stefan and Francois in due course. A great pleasure always to debate with them and hear their reflections on the banking crisis. So I think I can't do justice to all the questions that have been posed, but I'll try and say a few things on things that I understand a little bit better. And like anything, it takes a while to fully understand what has happened last year. I just started a course this Monday at NYU on financial history of the United States. We are starting in 1907 with the course, but I had to give students first an introduction to United States in the 19th century. And so, it can take a very long time to understand these banking episodes. But to cut a long story short, I think I'm going to make 3 points. One is that we need to understand why, in spite of regulatory efforts to curb fragile liabilities after the global financial crisis, we ended up with such a huge glut of uninsured deposits in the banking system. And I think one has to take a slightly system-wide perspective rather than just focusing on the individual banks that failed, as I'll try and explain. And my main point there is going to be that while private money creation that preceded the global financial crisis created a glut of wholesale finance, it could be that quantitative easing and to an extent the fiscal stimulus after the pandemic are creating a glut of uninsured deposits in the system. And I'll try and explain why this might be the case, which is that we might have shifted from private money creation to public money creation, but in either case, we ended up with fragile banking sector liabilities. And second, as a corollary to that, but one that's for the US, I think important to understand in the cross-section. So my first point is going to be a bit about the time series of all this. But the second point is more in the cross-section that of course, we were looking at fragile liabilities a bit more closely for the larger banks through liquidity coverage ratio, etc. They are also capitalized better, so that automatically means a lower gearing on the balance sheet. And therefore, what's happened is that liquidity risk is manifesting where it was not actually being managed that well, which is in the small and mid-sized banks. And I think this is an important combination of points because it's saying that if in time series you are creating a lot of fragile liabilities and you just regulate a part of the banking system not to take them on, then they're going to show up in the part that you are not regulating very well. And this has some implications for where perhaps the focus of the banking sector regulation might also have to be going forward. This is not to say that we don't need to regulate better the large banks, but maybe there's a particular issue in the small and mid-sized banks in the US, given the combination of these factors. And my last point is something I've been saying all along, probably for the last at least 15 years, if not 25, which is that we really need to embrace market signals and market data in supervision. We can't rely on regulatory capital requirements and liquidity coverage ratios alone. They are gamed, they have holes, they are not applied uniformly to all the banks, and that unless we pick up market signals, which is one way of thinking about mark-to-market of a balance sheet, both of its assets and liabilities, and also if we can improve our marking-to-market of the bank assets, not necessarily always for regulation, but at least for supervision, so you know where the vulnerabilities are likely to be, I think we might be able to avoid the kind of accidents we saw last year. Okay. So first point, which is the time series point. So of course, as it's well documented now, this one bank, Silicon Valley Bank, that sort of become the poster child of 2023 US banking stress, had an extraordinary surge in uninsured deposits. And yet there was something that changed here around the pandemic. Okay, so if you see its balance sheet is uninsured liabilities on balance sheet are growing at less than $5 billion per quarter before first quarter of 2020. And after that, there's a game changer. It shifts to first 10, then $20 billion per quarter. And the integral under that post-pandemic gray bar curve actually exceeds $100 billion. So, on average, it grew at close to $12.5 billion of uninsured deposits per quarter, about 3 to 4 times faster growth than what was seen before. And then there was first a slow outflow of deposits because banks don't pay the depositors high rates necessarily because they are trying to price discriminate between sleepy and flighty depositors. But then eventually there's a run when $42 billion gets withdrawn in a single day on March 9th. Now, what's interesting is that it's easy to say this was a rogue bank, very aggressive, etc., which all of it is true. But something very similar happened to the banking sector as large. Okay, so the US banking sector grew its uninsured deposits by over $3.5 trillion during the pandemic era. Its uninsured deposits were not even robustly growing in the period up to 2019 Q2. Starting in 2019 Q3, there is a somewhat robust growth because Fed actually starts buying T-bills very actively at that time, and something I'll come back to, which is that effectively quantitative easing started around the repo market spike of September 2019. And then you see a very rapid expansion. Okay, so the dollar numbers are now on the right-hand side, and you can see that the banking sector of the United States is basically growing its deposits at more than $300 billion per quarter. These are uninsured deposits. And of course, in one quarter, it has a very massive increase of close to 800 or $900 billion, I think close to $900 billion. Now, note that there is a sense that, if economic activity increases, deposit base will increase and that should grow uninsured deposits. This simply can't be the reason why banks are growing $900 billion of deposits in Q1 of 2020, because that's actually not the quarter in which economic activity is growing that quickly. There could be a flight into deposits, that could be a reason, but I'll try and explain that that's unlikely to be the full force here either. As a share of banking sector's deposits, the uninsured deposits were on a slight decline, coming down to about 47% just in the year before the pandemic. But then there's a 5% increase. So there's a very quick ratcheting up of uninsured deposits, even relative to the insured deposits. Okay, so even if you thought that deposit activity, deposit base overall increased because of the sharp rebound after the pandemic, this doesn't necessarily explain why the rotation happens towards the uninsured deposits. Okay. And then there is a withdrawal once the monetary tightening starts. So we need to understand this phenomenon. But first, I just want to stress this, which is that now if you look at the changes on the left-hand plot, I have changes in the uninsured demandable deposits of the banking system. And on the x-axis, I have changes in the reserves with the banking system. Okay, so I'm trying to gradually establish a link between quantitative easing and this surge of uninsured deposits and explain that it's the expansion of the Fed balance sheet. It's the expansion of the central bank balance sheets and the monetary increase that it creates. The mirror image of that on the liability side of the banking system is the creation of uninsured liabilities. And you can see this now in the quarter by quarter changes on the left-hand side, that whenever the reserves in the banking system expand, so do the uninsured demandable deposits. In some ways, banks are holding these reserves as the central bank requires them to after quantitative easing, but they are financing them effectively with uninsured liabilities. In some sense, these are, if you want, they are sort of borrowed reserves from the rest of the system. Now, of course, around the pandemic, there would be a concern that maybe the fiscal stimulus did a helicopter drop into the savings accounts of individuals, and that has found its way into these liabilities. First, we would expect this to have a bigger impact on insured deposits, not uninsured deposits. And that's what you see on the right-hand side, which is that insured deposits also seem correlated with reserve expansion. So partly during the pandemic, as you know, the fiscal stimulus is also effectively being funded by the central bank through large purchases of treasuries. But once you take out the fiscal stimulus quarters, the 3 stimulus quarters, there's actually no relationship between reserve expansion and growth of insured deposits. So in quarters in which Fed is expanding, but there's no fiscal stimulus, there is no robust relationship between reserve expansion and insured deposit expansion. To summarize, I think this is an important point that we think of the central bank balance sheet tool as a monetary expansion in the economy and an expansion in the size of central banks. A key point of data is that it's not just an expansion of central bank balance sheets, it's also an expansion of commercial bank balance sheets. And this expansion happens on the back of uninsured deposits, especially in the United States. Okay, and to just see this very, very clearly, on the left-hand side, you have sort of like initial balance sheet conditions with very simplistic balance sheets of the Fed, the banking sector, and public. What I'm calling as public, think of them as non-banks, basically insurance companies, mutual funds, pension funds, family offices, high net worth individuals, and the like. Okay. Now, what happens when Fed does QE? It's expanding its balance sheet as shown on the right-hand side. So it's adding treasury securities to its left-hand side, and it's expanding reserve liabilities on the right-hand side. Now, in the modern financial system, this tendering of treasury securities or agency securities to the Fed doesn't happen just through the banking system. A big part of this asset swap happens with the non-banks. Okay, so non-banks tender their securities via banks as their prime brokers. So what happens? They lose their securities on the bottom right, and banks credit their deposit account with now an uninsured deposit. Okay, so now this is a financial deposit that's getting created on the right-hand side of the banking system. What does the bank do? The bank is just a pass-through for the treasuries as a prime broker. So it credits the deposit account of the non-bank that tendered the securities, and the Fed credits the checking account of the bank with reserves. Okay, now you can see that therefore the commercial banking system has also expanded as a result of this. Now you might say, okay, what's wrong with this? This shouldn't have any implications for financial stability because the banking system got a very safe asset on the left-hand side, and it has now a liability, even if fragile, it's entirely backed one for one by the reserves. But the problem is now the cross section, okay, which is that once you injected these reserves and they created a one-for-one uninsured deposits in the system, once the money circulates around, reserves may not stay where the uninsured liabilities are. Okay, so a bank like Silicon Valley Bank may say, why am I sitting on these reserves? Let me go and make loans to the tech sector. Let me go and purchase securities. And these reserves will now move around in the system to a bank like JP Morgan, which says, oh, I need to be a fortress now because at some point these reserves will get unwound. At that point, there'll be fragility in the system. And I want to be the only game in town that can sit around and make acquisitions of banks which will get distressed. Okay, so this time series of QE expands the stock of uninsured deposits. And then the cross section of banks in their risk taking alters the reserves to uninsured deposit ratios in the banking system, creating a perfect situation for fragility because you've expanded the stock of fragile liabilities and then they will be sitting not fully balanced by reserves on those balance sheets where risk taking has been very, very aggressive, search for yield, managerial compensation, etc., etc. So you can see a little bit of this happening all through the last decade with the advent of QE, okay, which is that there's an overall increase in uninsured demandable deposit stock in the banking system, just relative to assets, okay. So you can see that for large banks above $250 billion, medium-sized banks between 50 to 250, and then for the smallest banks, you can see it's even faster, and especially so after the pandemic. Now, of course, we have liquidity coverage ratio. So if I scale these uninsured demandable deposits by something like the reserves of the bank plus the eligible assets, now I'm seeing which banks in the cross section have a mismatch between liquid assets and liquid liabilities, okay, which is where are their runs likely to happen, but there's not enough reserves backing them up. And now you can see very clearly the impact of the liquidity coverage ratio, which is that large banks' ratios of uninsured demandable deposits to reserves plus eligible assets have come down from 3 to closer to 1.75, okay? But in contrast, effectively, liquidity coverage ratio on largest banks is effectively an advantage to other banks if the stock of uninsured deposits has to expand in the system because of QE, because they are not subject now to as tighter rules, they have lower balance sheet penalty. And that's exactly what you see, that the smallest banks below 50 billion, which have no liquidity coverage ratio imposed on them, they are now becoming steadily illiquid over this period after the global financial crisis. And what's the consequence of this is that whenever shocks are materializing, like COVID or the Silicon Valley banking stress because of the pace of interest rate hikes and then the solvency concern runs, effectively, these are the banks that are becoming dependent on the Fed for emergency liquidity, okay? So it's creating a liquidity dependence, which is that even in an era of tightening, if these banks become fragile, through the lender of last resort, Fed has to actually start re-injecting reserves back into the system to liquefy the balance sheets of these fragile banks. So for example, during COVID shock, if you look on the x-axis at which banks had fragile liabilities, so now it's credit lines, which are a bit like an uninsured but off-balance sheet claim. So credit line plus uninsured demandable deposits is in the numerator of the x-axis variable, and reserves plus Fed eligible collateral is on the denominator. And you can see that banks which relied more on discount window on the y-axis, data on this is now publicly available because it gets released with a 2-year lag. You can see that those who had more fragile liabilities related to liquid collateral in the cross section are becoming more dependent on the Fed for liquidity at the time of the COVID year. For the last year, we don't have the discount window data, but you have a field in the call reports which is called as other borrowed money, which includes both the discount window borrowing as well as borrowing from federal home loan banks, which are sort of like a pre-Fed lender of last resort to these banks. And the three bars show you The light bar shows it to you for below 50 billion, then 50 to 250, and the dark bar is for the largest banks. And you can see the huge ramp up in the liquidity dependence of the smaller bank part of the banking system on the Fed. And that's because that's where all the uninsured deposits are actually stuffed on the balance sheets. Okay, so just coming to my last point, which is how do we deal with this? And the first point I want to make is that there are some market signals of fragility that perhaps we are not paying attention to. So what I showed in the previous balance sheets, previous charts are balance sheet metrics of fragility, like your undrawn credit lines plus uninsured demandable deposits divided by your potential liquidity, which is reserves plus eligible assets. But markets are also picking up signs of fragility, as I want to show you. And if you don't pay attention to this in supervision, especially because rules are not perfect or not uniformly applied, I think we just bear a huge risk that when runs happen, ultimately, you just end up extending the central bank balance sheet all over again. There are, of course, moral hazard concerns with this, which one may or may not take seriously, depending on what your profile is in terms of and what your preferences are, even as regulators. But certainly it's a problem because in a time of tightening, you might have to start doing liquefaction of the system through lender of last resort. So one arm of the monetary arm of the central bank is doing tightening, but the lender of last resort arm of the central bank may have to do easing if there is fragility during a tightening cycle. So just to give you two quick signals, one, I looked at implied volatility of option prices. Of course, this will be available only for reasonably sized banks. These won't be available for small banks. And you can see that throughout 2022, at the top, you have that Silicon Valley Bank and Signature Bank's stock implied volatility was substantially higher by at least 15 to 20% higher than all the other large banks. Okay, so the large banks here include JP Morgan, Bank of America, Citi, and Wells Fargo, which are relatively at the bottom. And you can see that starting middle of October 2022, a gray line is beginning to spike up as well. And that line is actually First Republic. So First Republic did not get priced for a higher implied vol in the market. These are at the money walls. If you look at out of the money volatilities on these options, even First Republic is actually ahead of the other four large banks even before. So it's a very simple indicator that one could have looked perhaps to see if in case of a shock, some of these banks will be more fragile. Coming to Credit Suisse, this is my even simpler example. Here, I'm just looking at market value. Martin already pointed to this, which is that market to book of many European banks are just alarmingly low. My sense is this is just probably lack of recognition of losses in a proper way and great freedom in internal risk weights on small business loans and certain other kinds of loans, which is that the book values or regulatory ratios are simply not stating the true risk of the balance sheet. Now, so what's particular about Credit Suisse? It's losing its stock market value steadily from 1st of February 2021, when bad news came about its loans to Greensill. And you can see there's a big drop right after that announcement. And then it's just like a train wreck waiting to happen, which is that 75% of its value has gotten lost over a 2-year period. And if as supervisors, you don't pay enough attention to this, saying, oh, banks are meeting my regulatory standards of capital and liquidity, clearly something is wrong. You can't have such a large bank losing 75% of its market value over a short period of time. So I want to be very clear. I'm not saying we should use market signals in regulation. I think that's very tough to do. I'm simply saying that we should use market signals in supervision, so that when there is a discord between regulatory signals and market signals, we can try and understand or escalate the matters of supervision on such banks that look vulnerable on market front. And last point, absolutely on this, which is, of course, some things are not marked to market on bank balance sheets, so perhaps market to book ratios can be low because of that reason. And I think there is also an accounting cycle that accentuates this market to book ratio fluctuations, which is that banks have a tremendous preference to switch securities and keep them in available for sale category during monetary easing, because they want to book the profits, they want to book treasury gains and offset any other losses they have and look well capitalized. Then once monetary tightening begins, they want to, if given an exemption, they want to switch from available sale into hold to maturity, and any new purchases they make, they want to switch into hold to maturity, because in a tightening cycle, they don't want to recognize losses. So at a minimum, they don't want to have treasury book or investment book offset their credit and other losses or erode the regulatory capital. I think this asymmetry, you can see in data that banks that do more of this sort of accounting gimmicks, these are the banks that generate very high accounting ROE in good times and look tremendously profitable. And there's a research paper by Stefan Ingves and co-authors now, which shows that these are precisely the banks, high ROE banks in good times, are the ones that show fragility and tail risk whenever a shock like 07, 08 or COVID or 2023 March results. I think all of this suggests that we need to throw sand in the wheels of this accounting cycle of banks. One way to do it is to cap the hold to maturity to a certain ceiling. Like in India, we have adopted, Reserve Bank of India has adopted that you can't have more than 25% of your investment book in hold to maturity at any point of time. That automatically puts a cap on the level of gimmicks you can do. So you won't be allowed a Silicon Valley Bank style 57% or 60% in your hold to maturity book. There were 4 to 5 banks that opted out of the certain capital filters, and they were allowed to switch completely when the monetary easing started from hold to maturity to available for sale in the United States. They went to zero hold to maturity at the beginning of COVID, and then they switched back into hold to maturity once the monetary tightening started. I think this kind of accounting cycle should not be allowed to take hold in bank rules. Let me stop there, Cornelia, and hand it over to you. Thank you.
Yeah, thanks very much. We overran a bit in time, but I thought, I mean, we should get your presentation to the end to make then the key points. So let me hand over to the second speaker directly. That's Till Schuermann from Oliver Wyman.
Thank you so very much for inviting me to this panel. It's really quite an honor to be part of such an illustrious group. Moreover, I have the benefit of going after really a terrific introduction from Martin. He gave a great overview. I'm going to pick up a lot of the themes that he introduced. And then Viral, it was perfect the way that you had described, really gave us a grounding in central banking, monetary policy, and a reminder just how important market signals are to this problem. So what I'd like to do is sort of fold in the theme of stress testing, capital, and a little bit also, but most importantly, driving towards a view of forming an approach that considers jointly capital liquidity stress testing. So let me start with the following observation. Traditional banks, in the act of when they conduct financial intermediation, so when they do what they do, exposes them really to 3 types of financial risks: credit risk, interest rate risk, and then also liquidity risk, which I'll come to. Note that I'm going to abstract from the market risk faced by trading and capital markets operations, other than interest rate risk, of course. And then there is that whole big woolly ball of wax called non-financial risks that I'm also going to abstract from, but I'm going to focus just on these dominant types of financial risks. And in fact, credit risk really is the dominant financial risk in traditional banking. Basic idea is that borrowers are going to be unable to meet their contractual obligations on loans. If you are a risk manager or a supervisor, regulator, what is the scenario that you'd like to consider in order to probe this vulnerability? And that is the kind of severe recession, maybe a significant increase in unemployment, and that's going to drive up credit risk. And the policy response in a state of the world like that is going to be to drop interest rates. And that has been really the canonical scenario, inspired by the financial crisis, but not just the financial crisis, all the kind of capital-oriented stress tests that we've seen across all jurisdictions really followed this basic recipe. What about interest rate risk? So here, interest rate risk comes from one of the fundamental activities that banks do for us. They do maturity transformation. And we also reckon with the different adjustment speeds of assets and liabilities to changes in interest rates. I'll come back to that in a little bit. What's the scenario you might cook up? Well, you might imagine a period of high inflation, high growth, so a scenario where the economy is very, very hot and you have to do something about it. And the policy response is precisely that interest rates go up. So these are two very different kinds of worlds. One where the interest rates fall in response to a shock in the markets and the real economy, and the other one is where interest rates rise. So one thing that we see right away is that you can't appropriately stress test a banking system or a bank with only one scenario. And that's distressing because the regime that most jurisdictions have followed since the financial crisis when introducing stress testing has been to just have one stress scenario, and it basically follows the narrative on the right, on the left. The banks have gotten a lot of, central banks have gotten a lot of grief, and the supervisors have gotten a lot of grief for not having caught this in their stress test net. I want to, before beating up on them, which has become too easy of a sport, we need to recognize that actually one of the risks that did exist and still exists in the banking system was caught quite well in the stress scenario in the last couple of years, but particularly the one in 23. So the reason 23 is of interest is because that is the period exactly during which the turmoil happened in the banking system, Silicon Valley, First Republic, and so on failed. The big credit exposure in the system was commercial real estate. So let's take a look at the Fed scenarios over the course of time. The stress test regime has been in place for about a dozen years. And what I have here is the commercial real estate price index, and in changes indexed to the jump off point, so the end of the observation period, looking at projection quarter PQ forward over the next 3 years, which is what essentially the stress test looks at. The most severe shocks, and that was a drop of 40% from the beginning, were in 22 and 23, so the prior two cycles, but also a year right before the pandemic in 2018. So arguably, this was appropriately recognized. Now, in the last couple of years, commercial real estate stresses were not just all over all classes of commercial real estate, and this is an index that covers all classes of commercial real estate. It was actually fairly concentrated in office space. So let's zero in on this. And remember, this is actually sort of precisely how you'd like to design good stress tests. You'd like to design a scenario that probes precisely vulnerabilities that exist at a particular time in the banks and in the banking system. And that, at least for this risk category, is exactly what the Fed stress test did in 23. They told us in their disclosures for the first time how they treated a particular subsegment of an asset class. In this case, because it was quite well known that office space was where the vulnerability was, driven by this work from home trend, that it was important to tell the public, well, what actually is going on in this particular space. So what I have here, and this is from the disclosures, are the loss rates over the 9-quarter horizon just for office space. And what we see is that in 23, the loss rate projected for this office space was much higher than the average for commercial real estate, which is indicated by the red line, more than double, in fact. Which means that there are other parts of the commercial real estate space that had fewer losses, probably things like industrial warehousing, since we were all ordering from Amazon to make sure that we could stay and work at home. And so that stuff has to go somewhere. It goes into industrial warehousing. Just as a reference point, the dashed line is the actual loss rate that we experienced during the financial crisis, just to give us, again, sort of a reference point as how big is big and how small is small. So that's fine. We have at least some hope that the stress tests were able to give us some indication of where the stresses are. But of course, there's a bunch of stuff that we missed. So I want to now come back to interest rate risk and liquidity risk. So we already established that the financial intermediations makes banks naturally long credit and interest rate risk. Maturity transformation also exposes banks to liquidity risk, and in fact, it exposes banks to liquidity risk on both sides of the balance sheet. So liabilities, this is straightforward. The demand deposits are by definition overnight obligations. Assets, on the asset side of the balance sheet, there are liquidity exposures through the distribution of lines of credit and loan commitments. So you might say, oh dear, this is incredibly unstable. What happens if there is a shock to the system and people show up on both sides of the balance sheet at the same time? Thinking through that, you might wonder how a bank in the banking system can survive a week without a crisis, let alone many years. Well, Kashyap, Rajan, and Stein, in an important paper that came out in 2002 in the JF, said, look, don't worry. Actually, as it turns out, in a systematic liquidity shock, these two things hedge each other. So what you have is not a run from the bank, you actually have a run to the bank. And that is precisely what happened in examples like LTCM in 1998, but also in the fall of 2007. Now, this hedge doesn't come from nowhere. It comes from a particular place, and that is the existence of deposit insurance. George Panaki showed us that this natural hedge actually didn't exist before the introduction of deposit insurance in the US. So deposits also hedge conveniently against interest rate risk, and this has now received a lot of attention, this idea of the deposit franchise being one of the principal sources of value for a bank. So the idea here is that cheap insured deposits are resistant to interest rate rises, and this what we call a deposit beta. So the change in deposit rates coming from a change in interest rates is a lot less than 1. Now, okay, but should we therefore really not worry? Well, the problem is that, as we saw starkly, and as Viral has illustrated quite nicely in his discussion, this deposit franchise value actually derives from insured deposits. Uninsured deposits are not a source of value here. And a paper by Drexler, Sava, Schnabel, and Wang actually lays this out very, very nicely. As a reminder, SVB share of insured deposits was only 6% at the end of 2002, and actually it was the last time we had regulatory data on them. And it actually declined even further than that in the run-up to their run. We have this information is public. That is to say, we can see for banks what their share of uninsured deposits is. In addition, we can also see what their losses are in their securities book, and this is where all of these these two things come together: interest rate risk and liquidity risk. It is, in short, hard to hide interest rate-driven losses in the securities portfolio. And let me show you how, or let me show you what that picture looked like. This is a chart published by the FDIC in its quarterly banking report. This is the chart that was displayed in early 2003 of data through the end of 2002. And what we see here are the unrealized gains and losses of the investment securities in the two accounting flavors that are available to banks: held to maturity and available for sale. And the picture goes back to the financial crisis, and it is really quite stark just how large the increase in unrealized losses were in the securities portfolio, and how large the proportion of that was in this in the category of held, or as is sometimes called, hide to maturity section of the portfolio. Importantly, it didn't take very long for the signal to arrive in the public. Already by the first quarter of 2002, and certainly halfway through, it was really quite clear how quickly those losses were building up in the banks. And only some of the banks had to, of course, account for at least the available for sale portfolios. None had to account for the held to maturity portfolios in the capital position. All of this then comes together in a toxic brew of uninsured deposits, the held to maturity securities, and the way that we measure and account for liquidity adequacy in the post-financial crisis way, which is through high quality liquid assets. Remember, the liquidity coverage ratio is essentially the liquidity you have, HQLA, divided by the liquidity that you need, which is the liquidity requirements that essentially come through a very stylized stress scenario. Now, here what I have is just simply a very, very stylized balance sheet. As you move further and further, as more and more assets are held in the HQLA, and a lot more of that was the case following the financial crisis through pressures to banks to self-insure against liquidity stresses. Some of that, how much of that, is in held to maturity. Viral told us about the large increase in uninsured deposits and held to maturity. In 2022, banks in the U.S. moved almost $1 trillion of securities from AFS to HTM, and they're strong simply because of those accounting-related and regulatory capital-related incentives. This helps to explain, in part, why the Fed needed to introduce this bank term funding program in the wake of the Silicon Valley default, because it is that program essentially allowed banks to park the fair value losses and use them and be able to post them to increase their liquidity position. It is a reminder that HQLA, the liquidity is needed when it's needed at a time. The fair valuation reality comes to the front, and you can no longer hide those losses because even in a repo trade, that happens at fair valuation, and so whatever losses have been unrecognized will have to now in some form be recognized. Let me now sort of start to race towards the end of my remarks by describing how we go about just the mechanics of stress testing. And the reason I want to do that has become clear in a second, is that I want us to start to think about, like, well, how can we start to marry these two sources of financial strength or weakness on both sides of the balance sheet, namely liquidity and capital. So mechanically, stress testing essentially translates these macro scenarios into financial impacts. It will depend on how often we take a look at the health of the patient. So we start with a particular balance sheet. A shock starts, it generates an income statement. An income statement in the first period in the shock scenario, which is already experiencing shock, so it's not an ordinary income statement. It produces the next period balance sheet and so on. I'm not saying anything here about the different of the length of the periods. In stress testing, capital stress testing, that is in most jurisdictions a year. In the US, it's a quarter. I'm not saying anything at the moment also about how long the forecast period is. It is typically in stress testing somewhere between 2-3 years. Some jurisdictions go up to 5, at least for capital purposes. In climate stress testing, we have a similar idea, but the interval is much wider than 1 year. It is starting to converge to about 5. The horizon is many decades. So this basic idea of how we conduct stress testing is illustrated here. Regardless of the particular application, it is the act of understanding the evolution of the balance sheet and the income statement over the course of time. Now, typically this conversation is done in capital ratios. It's going to be only as good as the capital regulations that you live with, and it's beholden to the accounting regime. One first step that we can take in order to fold in liquidity is to just test for the LCR at every period to see if LCR is still holding up under those stressful conditions, and indeed fold in a test. Well, if you were to fully fair value the HQLA portfolio, would it still survive the LCR test? Now note, in the canonical scenario, actually, because interest rates drop, HQLA would increase in value, but this I think is a fact of life that I would be willing to live with if I were able to, in turn, under a rising rate scenario, be able to test for on rising rates, we're going to be able to test for the stresses that are embedded in the HQLA portfolio. So, as a final slide, I want to just focus in a little bit more on this idea that capital and liquidity stress tests really exists on a continuum of assessing a bank resilience to shock, right? Much like the doctor looks at the health of their patient, you show up at an annual physical. The patient, me, only gets tested by the doctor once a year. Who knows what happens in between? But if you're in the hospital, one of the advantages of being in a hospital is that they monitor you on a very high frequency basis, and so are able to assess deteriorating health very, very quickly. Liquidity stress testing has evolved enormously also in the last decade since the financial crisis. We have LCRs type stress testing, which is done at a frequency of about daily or weekly, extending maybe monthly, but it's really a daily, weekly. Increasingly, and the largest banks are expected to do much more high frequency liquidity stress testing on the order of hourly and even minutely, particularly for trust and custody operations. This gives us a very granular view of how the health of a bank is evolving over the course of time, when the time interval is extremely short. And conceptually, it's easy to imagine how you could develop estimates of a balance sheet and income statement at that high frequency. We're used to the right-hand side of the picture of extending that interval to quarterly or really yearly, which is what is done in most jurisdictions. The problem, of course, is that we don't know what happens to the health of the bank in between those periods. And particularly if the interval is a year, a lot can happen in a year that might result in the bank not being solvent by the end of that observation period. So we can take this basic idea of stress testing and just shrinking the time interval to get a much better sense of what happens to the dynamics between the liquidity demands, or what we view as liquidity demands, conditional on the evolution of capital and the funding profile. So let me stop there.
Thanks very much, Till. So yeah, I mean, you have a good point on the time dimension of stress testing. No, indeed, here in the Euro area, we do every second year our EBA stress test, and of course, a lot can happen in between. So the 2021 stress test was still based on the low for longer, like you said also in the beginning, and then we had to live with that scenario for 2 years before then the new stress test came in 23 with a very, very different scenario. But I'm very lucky that Francois-Louis from the EBA is also here, and I'm glad that you could connect now. So maybe Francois-Louis, you could answer to some of these questions. Thanks.
Thank you, Cornelia, and thank you to the organizers for this very nice panel. Very happy to join you today and to see a number of colleagues I've been working with or for over the years. Good to see you, Martin, again. Also very good to be here with Stefan. I remember my time at the BIS when Stefan was very active over there, and then also when he was chairing the ATC in the ESRB, the Open Systemic Risk Board. So I'd like to say, first of all, thanks for the topic. I think it's important that we speak about those topics and what happened last spring. And I would certainly agree with the title of the session. This time is not different. That's very clear. And I would like to maybe make 4 remarks before I dive into very practical and mundane topics. First, lesson learned, if you want, is that, and we've been discussing that and publishing it as part of the work that we did in the Basel Committee, where we sit with Cornelia, that this was very much a supervisory issue this time around, much more than a regulatory issue. I think it's important to keep that in mind. In that regard, I would also agree that our supervisors, I've been a supervisor in the past, I'm a regulator now. EBA does rules for banks and for those who supervise them. But as a supervisor, you need to be able to pick up market signals. That's very clear. It is something that supervisors need to do. And the second point, which is related to that, is that in Europe, I think it's fair to also mention that this was a very serious test that EU banks have passed successfully. So it's important to mention that and highlight that also in the vein of what we've heard many times about possible weaknesses or hidden weaknesses of European banks. I mean, we've been passing that test successfully. It's important to note. And there were probably 2 or 3 main reasons for that. And that's my third point. The first reason is that there was a lot of de-risking since the great financial crisis which started in years 2007 and 8. Secondly, there was also a lot of preparatory work, both on the regulatory side and on the supervisory side. From the regulatory perspective, I mean, we've been, enhancing our tools for monitoring IRBB, and we've been developing tools for supervisors to use well before the new market environment got fully in place. And supervisors have been using that. And then lastly, there was also a systematic application of the Basel rules in Europe, which certainly proved useful to avoid, sort of the clustering effects that were so detrimental on the other side of the Atlantic. A fourth general remark is that what we have seen from our perspective was pretty much a textbook situation. The one novelty was certainly the speed of the deposit outflows, which were facilitated and amplified by a combination of the ability for customers to use new apps and withdraw their deposits much more quickly, but also social media. And that's certainly something that we'll have to take into account in the future. It's not possible anymore to wait for the weekend, the resolution weekend, or to expect that, at the closing of markets, the situation may calm down. Now, let me maybe dive into 3 main, more technical, 3 points, which are a bit more technical. First one is the approach in the EU to valuation and capital requirements for banks' bond portfolios. As we know, the valuation of banks' bond portfolios is strictly dependent on the accounting classification. And according to IFRS provisions, which are the accounting standards used by most of the banks in the EU, financial assets can be measured at amortized cost, at fair value, through other comprehensive income, or at fair value through profit and loss, depending on the institution's business model. So this classification has important implications for Prudential own funds figures and related capital requirements. A change in the value of the bond portfolios will not affect capital figures for instruments accounted at cost, while for instruments measured at fair value through profit and loss, of course, and through other comprehensive income, fair value changes will directly impact their capital calculation. In this regard, it's worth to highlight that in the EU framework, differently from some other jurisdictions, unrealized gains and losses recorded on items valued at fair value in the balance sheet are fully taken into account for capital purposes under our capital regulation. Regarding the capital requirements, the accounting classification is also a relevant driver used to distinguish between the trading and the banking book boundaries, to which different Pillar 1 capital requirements will be applied. In fact, bonds classified under the banking book will be subject to credit risk capital requirements, while bonds under the trading book will be subject to market risk charges. Moreover, bonds measured at fair value will also be subject to prudent valuation rules. So why am I saying or reminding all this, which is very well known, I suppose? Because I'd like now to focus on one aspect that has been put again under the spotlight following the last crisis, which is the treatment of the held to maturity bonds, which we call held to collect in the EU, and the risk of materializing losses that may be embedded in those portfolios. Accounting-wise, the treatment of those held to maturity portfolios is coherent with the assumptions that those instruments will be held up to their envisaged maturity, which has the important implication to allow banks to not recognize market fluctuations in their financial statement and thus avoid undue volatility in their P&L. The recent bank failures have reminded us that banks may be exposed to downside risk should they, against expectations, be forced to liquidate at any given point in time all their bonds held at amortized cost, and thus that means that we would have to crystallize unrealized losses embedded in their held to maturity portfolios. But the lesson learned from past crises has also been that this downside risk is generally highly correlated to poor risk management practices and excessive risk taking on interest rate and liquidity risks. Poor asset liability management practices, excessive maturity transformation, as we've heard before also, may indeed increase the risk of realizing losses due to forced sales in cases depositors withdrew, and that would increase materially unexpectedly their losses. Against that background, let me insist and repeat maybe that in the EU, our prudential framework has proved adequate to identify and address the financial risks of all financial assets, regardless of the measurement basis used for accounting. We have important prudential safeguards, and they help address financial risks associated with held to maturity bonds. Why is that? One reason is that in the EU, we have fully transposed in our prudential framework the regulatory standards and the tools envisaged by the Basel Committee to address interest rates and liquidity risks. We look at that from an EVE and from an NII perspective, to say it differently, constantly. And we've been looking at that over the past 12 months before the crisis materialized. Let me illustrate. In the EU, all the financial instruments, including the bonds held at maturity that are accounted in the banking book, are subject to the Basel Pillar 2 requirements on interest rate risks. Under this framework, EU supervisors can and indeed do assess and do monitor banks' overall exposure to interest rate risk in accordance, and as a result of this assessment, they may undertake additional supervisory actions where necessary, and they indeed did it before the March turmoil. Moreover, in the framework for liquidity risk in the EU, contrary to cases observed during the turmoil in March 2023, the Basel LCR rules are also fully implemented, and that's across the board to all banks operating in the EU. This ensures a minimum amount of high-quality liquid assets being held in the LCR. HQLA are calculated considering their market value, even for assets accounted at cost. So the determination of the liquidity buffers available for banks to withstand potential liquidity outflows is not influenced by the accounting regime. As banks may liquidate their HQLA portfolio either by selling or repoing them, including with the central bank, it should be noted that repoing it ensures that the liquidity assets at amortized cost would not trigger an impact via losses. That's the situation in the EU. Finally, let me insist that what we did last summer in the context of the EU-wide stress test that Cornelia was just referring to now, we've also complemented the analysis with a specific ad hoc analysis to better gauge the magnitude of possible unrealized losses on bond holdings and to measure the hypothetical downside risk. This information was available already through bank disclosures, but we thought it was important to put that much more easily available to market participants in a much more harmonized framework to shed more light on what's the situation. And the result of this work that we published in last July, showed a quite reassuring picture that, in fact, those unrealized losses on bond holdings in the EU banking sector were currently much more limited in size compared to what we've seen in other jurisdictions. So I think that's also something that we should take comfort from. A few words on the AT1 instruments and their role in terms of loss absorbing capital in the EU. As you probably or hopefully remember, together with the SRB and the ECB, the Monday morning after so the Swiss authorities took action, we published a statement, a common statement, reaffirming the place and the role of AT1 instruments in banks' capital structure. We said very clearly that the creditors' hierarchy would be respected in the EU. That is, that common equity instruments are the first ones to absorb losses, and only after they would be fully used would additional Tier 1 be required to be written down. That was applied also in past cases in the EU. So this is the situation that we have in the EU. Let's not forget that legislators chose to give AT1 a role in various capital requirements, and that's something that's been also strengthening the capital situation of banks and their loss absorption capabilities so far. A quick word on do we need to do something with regards to Basel III in the EU, because that's a question that we hear is also commonly and frequently asked since we published the paper in the Basel Committee. I think in the EU, we have now the texts of the banking package, the new CRR, the new CRD. They were finalized in trilogues last summer. Sort of a definitive agreement was reached, and now on the 6th of December, last December, the final text have been published. Those rules will, in fact, make banks in the EU even more resilient to potential future economic shocks. We've already benefited a lot from the first installments of Basel III that helped us withstand the shock of last spring. And we believe that this will also contribute in the future to Europe's recovery from the latest effects of the pandemic, and also help us to transition towards climate neutrality. The banking package has a number of innovations in the prudential framework for banks. It implements the final framework set up in the Basel III Accord. It ensures an international level playing field. It also takes into account specific features of the European banking sector. But more than that, the package will contribute to a green transition because it includes a set of rules requiring banks to systematically identify, disclose, and manage the risks arising from ESG factors as part of their risk management. And finally, the banking package in Europe provides, deepens, and facilitates access to the EU single market with stronger enforcement tools for supervisors which oversee EU banks and third country operating in the EU. So we are very happy with this new banking package. We'll now be working, and we've started working on making that even more practical. We published a roadmap last December, which explains at which speed and pace we will be coming up with the text, facilitating the implementation in the EU that will spread over the coming years and will help further strengthen the situation of the package. I'd like to say a final word on what I heard before on the price to book of EU banks. I, of course, do not subscribe to the comments made earlier that risk weights applied by EU banks are not reliable. I know that this was a common view 10 years ago, but let's also accept now that after all the work that the EBA first, but also the ECB and their systematic review of internal models have done, now all the possible concerns and questions around that should have been dispelled. So I think there is now a lot of evidence over there, which is there for people to understand, to read, and to grasp, and that should really put that question and those considerations. Frankly, as a topic of the past. I'll stop at that. Thank you.
So lots of interesting questions. Thanks, Francois-Louis, for giving the European perspective. And I found it interesting that you remembered this AT1 statement that authorities were putting out, because, I thought the whole situation after the failure of Credit Suisse was so shaky that you could see how quickly contagion can happen, and just informational contagion, so to other areas of the banking sector in the world that were completely unrelated to the events that were actually taking place, and how public communication is actually needed sometimes to calm the markets. But I would hand over to Stefan now for the general policy lessons of everything that we have heard today.
Well, first of all, thank you. It's a privilege to be on this panel, and it's also a joy to see old colleagues and friends on my screen. So thank you for giving me this opportunity. Kalomiris wrote a book some years ago with the title "Fragile by Design," and Reinhard Rogoff wrote the book "This Time is Different." And if you combine those statements, you get maybe not so different. On the one hand, history does not repeat itself, and we can learn from history. And we know by now that banks can go under in many different ways, but not in an infinite number of unknown ways. Hence, déjà vu. And after 30 years in this business, I have stopped being surprised when it comes to banks going under, almost regardless of in what corner of the world this happened. So then, now what about this 2023 episode? Well, by now, hundreds of pages have been written on this topic. And they covered almost every imaginable angle of what happened, but still a few reflections on my side. As I said, banks can go under in many different ways. And if you look at the SVB and you compare with the Credit Suisse example, we have two different stories, but the end result is the same. And that's because banks are prone to runs. But you cannot really ex ante know when the trigger point comes. It's only ex post that everything seems obvious. And that's, of course, one of the difficulties when it comes to dealing with supervision, bank runs, and central banking broadly when it comes to being lender of last resort. Also, which is well known by now, is that mismanaged small banks can also create a big problem. And it becomes even bigger if there is what I would call joint mismanagement, both on the supervisory side and on the bank side. And this creates uncertainty, and all in all, this can exacerbate runs, and that's a difficulty in itself. And I think that we have learned over the years that swift, decisive, and transparent action is vital. And if you say that there is not a problem, then people will run almost for sure. So never say there is no need to worry, because then people will really worry and help head for the exit. Also, what shows up in all these documents is that bank governance is a perennial issue, and various levels of supervisory intrusiveness is also a perennial issue, or actually in most exposed cases you find or will find a lack of intrusiveness. At the same time, when these mishaps happen, then various types of regulatory lacunae bubble up to the surface, and we take a look at them. And let me mention just a few, and all of them I think have been mentioned by others already today. When it comes to dealing with interest rate risk in the banking book, that whole issue was always, from the Basel Committee's perspective when I was there, on the back burner. And the BCBS was not really allowed to touch it, and that was for reasons that I could never really understand. And now that, of course, comes back to bite and haunt us. At the same time, and others have touched on these issues already, a corollary is the debate about available for sale versus hold to maturity, and actually versus mark to market versus accounting rules. And all the effects that you have or do not have on the capital when these episodes happened. I would say, though, that never forget the leverage ratio, because basically risk weights are sunny weather measures. but the leverage ratio defines the size of your umbrella or the size of your rubber boots. And that is very, very important. At the same time, and this is certainly my personal view, there is absolutely no need to have something called AT1. That's a political project, and that's a concession to politicians and bankers. First best is just to get rid of it and turn all AT1 into just equity. But it's my own view. Now, the thing that always comes back is if you do not mark the market will do it for you sooner or later in one form or the other. So it's better to be transparent. It's better to be ahead of the curve and accept that market values do matter. The Basel Committee spent 40 years discussing capital rules, but only 10 discussing the implementation of liquidity rules. So the BCBS actually, when it comes to liquidity, came late to the game, and we should ask ourselves why it happened during the 50-year anniversary of the Basel Committee. And this is, of course, in some sense a side issue, but it's quite interesting because so much time was spent on capital and not much on liquidity, and now we're discussing what happens when you don't have enough liquidity. So I do think it's worthwhile for the Basel Committee to take a new look at the LCR and the NSFR, and also to look at how you define high quality liquid assets. And we should ask ourselves whether there needs to be some tweaks to the runoff rates, because the runoff rates, of course, really, really matter when you calculate these ratios. The G30 report, which is also what is referred to for today's discussion, touches quite a lot on lender of last resort and collateral, and they discuss how you should preposition collateral. And they essentially carry out a conversation about how to balance LCR, NSFR, collateral, and being lender of last resort. This is a very US-centric approach, and I'm not complaining about that, but the issues and the ideas, I think, are the right ones, and it's something that should be studied in many different parts of the world. Also, most academics are trained to think about central banks and central bankers. They talk about being lender of last resort, but in a systemic situation with a concentrated banking sector, and that certainly is the case in quite a good number of countries, the government and its institutions become de facto the owner of last resort. And sometimes not enough focus is put on that, because we tend to talk about this in terms of resolution programs and schemes, and then you say that you just do these things, and sometimes it's actually not so easy to do it. Resolution plans are definitely helpful, but unfortunately, we have learned from experience that markets function the worst when we need them the most. And that is why, in some instances, resolution probably will take much longer than most people expect. Let me also make a few comments on runs and a few examples on runs that I have come across when I've been working on these issues. Back in Sweden in 1992, when the whole system went down, it was essentially a money market run in London. And my experience is that usually it takes actually quite a long time before depositors, small depositors run. And normally actually a bank goes under before that, because the professionals start getting suspicious and want to get out. Northern Rock is a very different case, because I recall that the Northern Rock website crashed. So that was actually one of the first attempts when people tried to get out, doing it electronically and not just lining up outside the offices. A very peculiar case is what happened to Swedbank in Riga during the Baltic crisis. Rumors and cell phone messages in Riga actually emptied all the ATMs of a solvent bank. And that was a sort of an early indication that when technologies change, Sometimes bad things can happen also to a solvent bank, and it took about a weekend and a few more days to explain to the general public in Latvia that there is no problem with Swedbank at all. And then, of course, we have discussed, and others have discussed today and at length, the SVB digital run and what might happen in the future. Now, I do think that when it comes to the future, that runs could potentially be quicker, faster, come sooner than in the past, and that is an issue it's in itself because there's new technologies available. But what that implies also, and let me use one example from what happens when you take a course in rhetoric. One of the first rules is you should know your audience. Now, in banking, we have something similar going forward. You should know your depositors, and you need to know and understand what withdrawal technologies are available. And in addition to that, very much in line with the rhetoric, you actually need to learn and understand how to communicate, because usually choosing not to communicate just makes things worse. In the G30 report, if I use that as an example, they also say that monetary policy matters for financial stability, and Viral has touched on that already. And from my perspective, this is music to my ears. And many have chosen not to listen for a long, long time. And I do think it's an academic failure not to deal with this matter also from a theoretical point of view. A remaining issue in this field is also to figure out how to communicate between what I call microprudential, macroprudential, and traditional macro. Because if you have silos, then you do the macro stuff, you do monetary policy at one end of the central bank, and then maybe too late in a bad scenario, you realize that when the policy rate goes up, the banks end up with all sorts of problems, and then the micro guys have to deal with that as best as you can. And one really need to be aware of what is going on in the system as a whole, and one, particularly when you do macro, you have to understand the national plumbing, if I call it that, when it comes to the financial sector, because otherwise you run the risk of making mistakes. And if you make mistakes, you run the risk of actually creating problems in the financial sector. And if you end up with problems in the financial sector, then essentially you have lost the transmission mechanism, and that makes monetary policy very difficult to execute. So thanks.
Thanks very much, Stefan. So we come to the end of this round of statements. I think we can still have a few minutes and to react to each other and also to answer some questions in the chat. I see there was already a lively discussion on stress testing, frequency, and whether we shouldn't move more to a system of multiple stress tests, which I would anytime subscribe to. Only it's a matter of resources. That we also have to consider, and I'm really very happy about the very interesting thoughts that you gave today on accounting, on held to maturity portfolios. I think there's a lot still to think about, and how we deal with that on the regulatory side. But maybe I can just give the floor back to you, each of one, for just to react to each other, or maybe even have a concluding statement. So Viral, could I start with you?
Thank you, everyone. Learned a lot. I think I mostly agree with everything. I'm sorry, Francois, if my assertion or conjecture on internal risk weights of European banks is off the marks. I've always, though, struggled to understand why the European banks' market-to-book ratios can be so low on a persistent basis. I can understand if they are low for a year or 3 years, but it's now like 15 years, and I can't square it up with market discount rates being off or cyclical or anything. So I think I would love to see any literature that is out there explaining why the market to book ratios can be persistently low for 10 to 15 years like that. And I'm very happy to be convinced. And if indeed the risk weights you think are now more accurate with the risk of assets, that's very good news. So I would look forward to seeing the research. Thank you.
Till, anything from your side?
So this is just a fantastic discussion. Thank you so much for hosting all of us. Just two comments. First, I think Stefan made a number of really insightful remarks. The one that really stood out to me, in addition to the know your depositors, is that if you don't mark the book to market, the market will do it for you. This is in particular true in a crisis. Nobody needs to pay attention to things like the securities book when everything is fine. When everything is not fine, reality starts to strike quite quickly, and we ignore the market at our peril. So that's one. The second is this debate about leverage ratio. So Stefan also reminded us that the leverage ratio exists, and it is not useless, far, far from it. One of the things that I pay a lot of attention to when I look at the results of stress tests is actually the difference between the pre and post stress leverage ratio. And the reason is that a stress test is simply a bespoke risk weighting algorithm. And it is difficult to compare pre and post stress CET1 because you're mixing two models. You're mixing an existing risk weighting algorithm model and the new model, which is slightly different every time you do it by design, and that is the stress risk weighting. And so for me, the most informative resilience measure of banks is the difference between pre and post stress leverage ratio.
Thank you. Francois-Louis?
Yeah, I'll just react to the price to book topic and what Viral was saying before. You're absolutely right, Viral, that it's been a topic for EU banks. Why was the evaluation? Why have they consistently underperforming US banks in terms of profitability, and also why is the price to book ratio so low? I think first, the good news is that it's picking up. I mean, recently it's been picking up slightly, which is good. But I think the main explanation that we have, and I'd be very happy to continue the conversation, and we need a different forum for that, but is that I think the banks are long the economy, and the growth prospects in the EU cannot compare with the ones in the US. And I think to some extent, and beyond anything about possible inefficiencies and cost income structures and things like that, I think that's the first reason why banks have been underperforming for quite some time, and also why there are still lingering doubts about their capacity to sustain higher profits in the future. But again, I mean, that's a whole topic that we should really be spending more time on. Thank you for the opportunity again for such a great conversation.
Thank you. And Stefan, any final remarks from you?
Finally, a very quick remark. I could of course comment on many things, but it's touching on what you referred to, Cornelia, when you referred to the discussion about stress testing. And one is of course one of resources, another one is frequency, but there is another challenge when it comes to stress testing, and that is sometimes, and that particularly holds when you start at a very high level of aggregation, because then you start with all sorts of macro assumptions and you sort of fly in a helicopter above the banking sector, and then you look down and you make all sorts of assumptions, hoping that individual banks are in some sense connected to the macro. So that's what one can call top down. But when things really go wrong, when you look at things exposed, you can never escape doing bottom up, because bottom up is essentially what you do when you recapitalize a bank. And this is of course an enormous challenge when you do it, let's say for the sake of the argument, at the pan-European level, because normally you just don't have the resources to do it bottom up. But elements of combining top down and bottom up, I do think is very important. because also when you do bottom-up stress testing, in many instances you actually find that the banks and the bankers have no idea what's on their books themselves. And it forces them to take a stance on what stuff is worth when you do it bottom up. But from a resource point of view, quite a challenge, and also intellectually quite a challenge how to balance top down with bottom up. Thank you.
Thank you very much. So I think we can conclude this panel by saying there are lots of challenges ahead. No, I think there are challenges both for supervisors, and that came out in the reports that were published also last year. For regulators, as also Stefan has just summarized, I think quite well, we need to think more about the liquidity ratios, to what extent they may need to be adjusted to the new, more digital environment, the treatment of held-to-maturity portfolios. How about deposit guarantees? Now, some of you made the point that we have a lot of uninsured deposits, that can create troubles, but also for central banks, no, to think about what are the effects actually of monetary policy easing, of the quantitative easing that we had, that also in the financial world, this can increase risks. And then QT, and then any forms of central bank intervention that may be needed in the form of lender of last resort, and the moral hazard that may be implicit here. So lots of topic to think about for all of us. I think thanks very much to all the panelists. I really enjoyed listening to your talks, and I think I would like to close here, but hand over to Ernest maybe to a final word.
Thank you very much, Cornelia. This concludes our SUERF Baffi Bocconi webinar on the 2023 banking turmoil. Thanks to Martin again for organizing this and for your excellent introduction. Thank you, Cornelia, for your smooth moderation and for your insightful conclusions and summary. A big thank you to Viral, Thiel, Francois-Louis, and Stefan for dissecting the underlying causes of the 2023 bank turmoil, and for also showing us useful avenues for improving safeguards to further bolster the bank's stability in the future. Last but not least, thanks to all participants for your interest and for your questions and comments. I think the chat would have, if we had had the time, would have kept us busy for another half an hour at least. Thank you very much. Bye-bye and take care.
Bye-bye.
Thank you. Bye now.
Bye.
Very good to see you all.
Thank you.
Thank you.
Bye.